Apple Inc. leads the technology sector in stock buybacks, having spent over $708 billion, a staggering amount that demonstrates the company's commitment to returning value to shareholders. Since the onset of this strategy, the diluted share count has decreased by 34.6%. This reduction has significantly boosted Apple's earnings per share, underscoring the effectiveness of their buyback program. Apple's CEO, Tim Cook, has overseen this expenditure, reflecting a broader trend where companies buy back stocks to enhance shareholder value. Interestingly, these buybacks usually indicate a company's confidence in its financial stability and future growth. However, the actual impact on long-term investors can be nuanced. While companies tout returning capital through repurchasing shares, it's essential to recognize that they are using their owners' capital to buy stock from those wishing to divest. This transaction can lead to benefits for long-term shareholders if it results in a reduced share count. A lower share count can contribute to a higher earnings per share, which is a vital metric for investors assessing a company's profitability and performance. For instance, consider a hypothetical company with profits at $1,000 and 100 shares. This results in $10 of earnings per share. However, if the company reduces its share count by 10%, keeping profit stable at $1,000, the earnings per share would then rise to $11.11, reflecting an 11% increase. When applying this model to Apple, the effects are profound, as their 34.6% reduction in shares over the past decade has led to a significant increase in earnings per share by 53%, assuming all other factors remain constant. It's crucial to differentiate between gross buybacks and net buybacks that effectively lower share counts. The past second quarter revealed that just 20 companies in the S&P 500 accounted for over half of all stock buyback expenditures, according to Nicholas Colas of DataTrek. This statistic illustrates that not all firms experience the same advantages from their buyback strategies. While the act of repurchasing shares can send a positive signal to shareholders, it doesn't inherently guarantee that a company's stock will appreciate in value. The presence of new stock issuance for executive compensation or acquisitions can counteract the benefits of buybacks, leading to a net share count increase rather than a decrease. Therefore, investors should focus on companies that have managed to decrease their diluted common share count effectively. In a recent screen of technology stocks, 15 firms emerged as significant players, reducing their share counts by at least 20% over the past 40 reported fiscal quarters. Among these, HP Inc. and Jabil Inc. also made the list, alongside Apple, which stands out due to its unparalleled buyback expenditures. Apple's financial commitment to buying back its stocks was noted in its recent fiscal quarter, where the company spent $20 billion. Over the past 4 quarters, this totals over $90 billion, a remarkable figure that contrasts with the capital expenditures peers have dedicated to AI advancements. While Apple has taken a more conservative route in investing in artificial intelligence, this cautious approach has ignited debates on Wall Street about whether the company is missing out on vital innovations crucial for future growth. Seaport research analyst Jay Goldberg articulated a common sentiment when he noted the shift in investor mindset from an initial focus on buybacks to a growing concern over whether Apple is adequately investing in AI technology. The fear that Apple may be lagging behind in AI development stems from comparisons with rivals that have aggressively increased their AI-related investments, stoking worries among investors about the potential long-term viability of Apple's strategy. In contrast, those in favor of Apple's approach argue that the company is wise to prioritize its buyback program over AI investments until more clarity emerges regarding its AI strategy. They believe this caution is warranted until Apple has a solid plan for integrating AI effectively into its business model. Conversely, Alexander Laskin, a professor from Quinnipiac University, criticized Apple's significant buyback approach, suggesting it reveals a lack of high return projects for investing capital. According to Laskin, Steve Jobs' philosophy emphasized reinvesting profits to nurture innovation rather than repurchasing shares, and he argues that a focus on buybacks may hinder a company's growth potential in the long run. This leaves Apple in a complex situation where it must navigate investor expectations while fostering future innovations. As Apple continues to face scrutiny for its perceived delay in capitalizing on AI trends, the company's future strategy may prove critical. Investors are divided between applauding Apple's prudent financial management and expressing concern over the potential stagnation of growth stemming from underinvestment in technology that could define the coming decade. Meanwhile, notable tech companies like Meta Platforms and Alphabet have been engaging in their own stock buyback programs, also reflecting market trends toward returning value to shareholders. Both firms have made substantial commitments to repurchasing shares, mirroring Apple's strategies while simultaneously investing in new technologies. The challenge lies in balancing short-term shareholder satisfaction through buybacks with the necessity of fostering long-term innovation and competitiveness. As the landscape of the technology industry evolves, Apple's decisions regarding stock buybacks and AI investments will hold significant implications not just for its stock performance, but also for its reputation as a market leader. The question remains whether Wall Street will favor disciplined financial strategies or pivot back to a fixation on aggressive technological investments in a rapidly shifting market. As this debate unfolds, Apple's ability to communicate its strategy effectively to investors will be crucial. The responses of technology investors in the coming months will ultimately reveal how companies prioritize their investments in the face of evolving market expectations and innovations. Whether they lean towards immediate returns or long-term growth will shape their strategies and stock market performances for years to come, with Apple's experience offering a compelling case study for the broader industry.